Hello and welcome to SB Talks with our Chief Investment Officer Ashley Owen. Today is Thursday, October 13th, and we will be discussing, amongst other things, how high interest rates may be going, where may equity markets bottom, if we're heading for a recession, just how deep might it be, and really importantly, what we are doing to position portfolios to protect capital through this period. Welcome, Ashley.
It's all happening, isn't it? It's all happening.
It certainly is. Welcome, Ashley, and welcome to all our listeners, wherever they may be. So, Ashley, since the last time we sat down and recorded the podcast, we've had a couple of rate moves. The United States had its latest meeting of the Fed. Their range went up by about 75 basis points. Everyone in Australia got a little bit excited because the RBA only went 25 basis points, but that didn't last long.
Yes, the US has had 5 hikes. They're now at 3%, from 0 to now to 3% to 3.25% range. Australia has had 6 hikes. We started a bit later. We were asleep a bit longer, so we woke up in a bit of a fright. And we've had 6 hikes to 2.6%. And the fact that there was, the share markets fell pretty much straight line down to the middle of June, and then they had a bit of a respite, bit of a rally from June to late August. And
middle of August, yeah.
Then the Jackson Hole central banker meeting was very bearish, so so end of August was bearish, and markets fell during July as well. When the RBA only went 25 basis points, which for some unknown reason they thought was appropriate, instead of 50, the world said, "Ooh, pivot." The new word that time was pivot. So everyone got this idea that maybe central banks would pivot, i.e. slow down or pause. After the Jackson Hole meeting, that was a bit of change. So everything went up 6 or 8% around the world, including Australia. That lasted about 3 days, and they realised that actually that doesn't exist. So over the last week or so, we've had markets sell off again. So the theme of recession and stagflation, or certainly deep recession, whereas soft landing was the theme a couple of weeks ago after the RBA meeting. Anyway, so
the theme's a little bit more recessions coming. How deep might it be?
Yes.
U.S. markets, I think, hitting 2 years low this week. Well, while we're talking monetary policy, I know the UK is not necessarily the epicenter of the world economy that it was.
Don't tell them that.
But it's been an absolute, dare I say, fiasco over there, and quite scary in terms of what's been happening with their bond markets, and in response to a mini budget from new Prime Minister and her Chancellor.
Yes, you got inflation running at going back to the new Prime Minister. There was a choice between when Boris Johnson was sort of forced out. There was a choice between one side, which was their case was tax cuts, especially for the rich, plus a bit more spending.
So the Liz Truss camp.
And the Liz Truss was even more tax cuts and even more spending, plus also subsidies and caps on energy prices and a whole lot, and handouts for households to pay bills, and handouts for oil companies to cover losses if they cap the price, all those sort of things. Wacky, loopy deficit spending stuff. Anyway, Liz Truss got in on the promises of more stimulus. Now, when the economy is running at inflation at 10%, the last thing you want is tax cuts, and unfunded tax cuts. So I remember in...
markets didn't exactly love it.
So if you remember back, this bond yield route we've had this year, where bonds are down 10, 15% around the world, we haven't seen that in a century. The last time we had a bit of a bond rankle was about in the 1994, when we had, coming out of the big, deep early 90s recession, we had share markets do well, profits recover, and all of a sudden, fresh memories of 70s inflation in their mind. Everyone said, "Whoops, we need to, going to have to," and the Fed got up, Greenspan got up in January 94 and said, for the first time ever, we're going to be preemptive with rate hikes to try and capture this inflation before it gets back to the 70s inflation. At the same time, Clinton was running deficits during the 90s when he got in, and he was famous. One of his famous phrases was, Clinton said, "If I ever get reincarnated, I want to be a bond market, because they intimidate everybody. The most powerful market in the world, deepest, longest, historically the most deepest and long-standing market in the world is bonds, starting from Mesopotamia, 4000 BC. So Clinton said, I want to be a bond market because bond markets can clobber anybody for anything. And then consequently he said, right, he backtracked in 94, 95, and he ran the only 3 government surpluses in the late 90s under Clinton, who was Republican, who was Democrat, whereas the Republicans were small government, which doesn't exist. So that happened again. So basically the UK Treasurer, who'd been in power for a week.
10 days, yeah.
10 days. He said, we're going to do this massive... When they got elected on that promise of stimulus and tax cuts for the rich, or for everybody, including the rich.
So an emergency mini-budget was called.
So within about 3 minutes, the bond market woke up and said, you're not going to do that. We don't care who you are, sovereign government or whatever. We will clobber you. So bond markets literally jumped overnight. Bond yields jumped overnight, and everyone, bond investors, literally for a few minutes recorded 20, 30, 40% losses.
To the extent that a number of the prominent UK pension funds were on the cusp of collapse.
So pension, that's another issue. So bond markets woke up and said, we don't want... The bond markets run the world, as Clinton said 30 years ago. So it doesn't matter what the government decides to do, bond market will dictate what you can do. So a couple of days later, they backtracked and said, "Okay, well let's put those on hold and let's backtrack on some of the stimulus and the tax cuts." So that was a reminder that markets, in particular investment markets, and in particular the bond market, share markets less so, but bond markets determine what governments can borrow and what tax cuts they can give and how people live in their society. Share markets go up and down, no one really cares. They retire a bit wealthier or a bit poorer.
Bond market puts the guardrails of what the government policy in terms of fiscal policy can be.
Bond markets run governments, basically, and that's what a reminder that Clinton discovered, that Liz Truss discovered last week. So that is a reminder that over the last 30 years, you've had this massive disinflation cycle, and there's been 2, fiscal policy and monetary policy. Fiscal policy is government spending via bond markets, borrowing, or surpluses in the case of occasionally, and fiscal and monetary policy, which is interest rates. Over the last 30 years, you've had this very loose monetary policy, 0 interest rates, QE, 2 or 3 cycles of QE, all of which inflated asset price bubbles. Everything, shares, cryptos, NFTs, properties, commercial property, housing, everything went through a massive bubble. On the other side, you've had quite austere fiscal policy. You've got Europe and the Germans that run the European Central Bank, which had the austerity drive during the 2000, the post-GFC period, which caused the Greek problem and the Portuguese problem, the Irish problem and the Dubai problem. So you've had quite austere or quite responsible fiscal policy for the last 30 years, but you've had mad monetary policy, which created asset bubbles. All of a sudden, 30 years later, we get this inflation of 10, 15% around the world, including Australia. So they've realised that something's got to give. You've got to get interest rates back up to 3, 4, 5, 6%, which is normal in a functioning economy, which we've seen before. And at the same time, you can't just give people money to pay power bills. You've got to say, well, the power bills are high, inflation's high. That means spending will stop or spending will slow. That means job losses and recessions. But that's what's required to get the economy back in sort of running order.
To hit the reset button on the economy, essentially.
So governments around the world, and the UK led this charge and said, well, oil prices are high, energy prices, people are paying more for their energy bills, everything, food, everything is up, housing's up, rents are up, so we'll hand out money from governments to help them with that. The bond market crisis a couple of weeks ago said, no, you can't do that. You've got to run balanced budgets, or you've got to at least try and get the fiscal budget back into control. To
put that in context, I think the UK gilts went from being slightly negative to over 1% in the course of a week.
Yes, 30-year gilts, the UK government sovereign debt, 20, 30 years, the long end in particular, they were trading at £110 on par, which is because of the low rates of the last 30 years. And they dropped 60% in value in about 2 days.
Yeah.
Now, you mentioned UK pension fund. Now, pension funds around the world have always been stacked with bonds, particularly government bonds. Yeah. Why? That's the way it's been for literally thousands of years. Certainly the post sort of 1400s, 1500 period where you have banks. One of the rules for banks was we will let you print money and issue currency, but the cost of that is you have to finance your government deficits. So in Australia, for example, running a bank 30, 40, 50 years ago, pre-deregulation, one of the rules was you can run a bank, here's a license, but you have to buy our government debt, i.e. you have to finance the government for us. Yeah. So pension funds around the world, which is most of the big money in the world, are stacked full of government bonds. I remember sitting on a committee with I had the second largest Korean pension fund, which is the Korean teachers pension fund and public service pension fund. And they have an asset allocation for their entire book, which was basically 80% bonds. And they were debating, and I was helping them with this debate about 6 or 8 years ago, they were debating, and the rest of it was cash and a bit of property, but no shares at all in their entire pension fund. Their debate was, do we move from bonds at 80% allocation to bonds at about 75% and put the rest in commercial property? Again, no shares, no growth, no inflation protection in their portfolios. It's all government bonds dominate portfolios for long-term pension funds everywhere in the world, except for a couple of countries, and Australia is one of those. Australia's are very share-based and very little bonds. So UK pension funds, made the mistake that all pension funds in the world make the mistake, is they say, well, bonds are a defensive asset, and because we have to run conservative portfolios for our long-term pension obligations, we'll stack them full of bonds. Bad move, because they all lost money this year.
And particularly extreme in somewhere like the UK, because interest rates were essentially zero. So
That's right.
The potential for capital losses when they rose was all the more exacerbated.
Stupidity 101 and 102. 101 is stack your pension fund with bonds, which is just it's based on the idea that bonds are safe, and bonds aren't safe. We know that. The second stupidity 102, they made the mistake, was UK pension funds routinely not only stack their portfolio with government bonds, they then borrow against them. So when you borrow against it, you've got to put up a margin. And, of course, when the bonds fell from £100 par to about 30 or 40 or 50 pounds par, they have to put massive capital next morning by 10 a.m. for their margin calls. And, of course, they couldn't do that. So the Bank of England stepped in and said, we'll bail out UK pension funds only for a few days while their margin calls came. It's a reminder of the madness of asset allocation around the world, which has this idea that government bonds somehow are safe. 30 years of low rates have taught us that, but that's wrong. You look back further than that, and government bonds regularly lose money, and this year's is an example of that. But
it's really an interesting one as well, because we've gone through, if we think in the last 3 years in particular, the COVID crisis and the extent of government support that was provided to the economy through that, and the UK was facing its own very significant cost of living challenges. The government was pretty much rolling out the rescue wagon once again, and this time the bond market said emphatically, no, you're not going to do that this time. We're actually decided that game is over.
Yes, the bond investors, which is us, we have a very small allocation to government bonds in our portfolios. So bond investors, which is the big pension funds around the world, said to the UK government, we're not going to lend you money. So bond yields went through the roof. So that was a bit of a lesson. Meanwhile, in asset allocation terms, we decided about 2 years ago to take out 70% of the normal bond allocations, fixed rate bond allocation, out of portfolios. We have
the type of bonds you're describing there, those longer duration government type bonds that have more of that capital volatility when the interest rate outlook changes.
Right. So bond markets, fixed rate bond markets around the world are down around about 10 to 15%, which is unheard of. The last time that happened in the US was in 1921, when they had an inflation spike after the war. The last time we had a bond market crisis was in 1931, where Australia defaulted, a Greek-style default on its bonds. So every single bond in Australia issued to Australian investors was defaulted and restructured on the 17th of September 1931. That was the very day that marked the start of our rebound for share markets. That day we defaulted on bonds. So that is the story of the bond market. We have 2/3 or 70% of our defensive allocations are not in fixed rate bonds. They're in floating rate notes, which rise. The return on floating rate notes rises when floating rates rise. So they were paying cash plus 1 or 2% 2 years ago, which was 0 plus 1 or 2%.
Basically 1 or 2%.
Now they're paying cash plus 1 or 2%, which is 3%. Plus 1 or 2. So over the next year, you're going to see those paying out 3-4% cash.
Starting to get income of potential
finally
5% plus in time. Related to that, then you got a view in terms of how high interest rates will go? I know it's a moving target, and the debate around what's the new. Are we on to the fourth new normal now? I lose count. But what's the new normal interest rate? What's the neutral interest rate right now?
We started talking about this about a year ago, right here, and I said back then, rates were zero back then. And I said back then, look, a normal economy, I will explain what that means in a second, is going to have cash rates of around about 4 or 5%. And of course, everyone laughed. Meanwhile, 6 rates hike later, we are now 2/3 of the way there. And we know we're not going to get there yet until we are 4 or 5%, which means mortgage rates are 6, 7%. Shock horror, that's what they were 15 years ago before the GFC, so that's back to normal. What is a normal interest rate? And this is subject of debate for decades, but it comes down to a very simple idea. The normal cash rate that's required to prevent inflation rising and also prevent falling into recession. So it's an equilibrium rate. It's never fixed. It changes as the cycle goes up and down. But the normal rate in an economy is, and it's the same for every economy, it's basically the real GDP growth rate, which in Australia is 2 or 3%, which is the economic pie growing. US 2 or 3%, UK 2 or 3%, Japan lower, Europe lower because they've got demographics and ageing populations. But the good economies, which are Canada, US, UK, Australia, New Zealand, which are they're people importers, they've got immigration,
population
they've got growth.
Yeah.
They've got youngish working populations, unlike, say, Japan, which is old and dying, Europe's old and dying. But Australia, New Zealand, Canada, US, those 4 economies which are in sort of one basket structurally, the GDP growth, the pie, economic pie, is growing by around 2 or 3% per annum, in and out of cycles, but over many, many decades, and has done for the last century or two. Plus, on top of that, you add your normal expected inflation rate, which is 1 or 2 or 3%. So if you've got the pie growing in real terms of 2 or 3%, and you've got inflation, which will run over the long term at about 1 or 2 or 3%, add those two numbers together, you get 4 or 5%. So your normal cash rate, in order to prevent inflation rising, but also to prevent recessions, if they can, is around about 4 or 5%. And that oscillates up and down as you go through cycles. Yeah. That's what it was for the last century, 20,
so
30 years.
It should have been 3 in a bad time and 6 or 7 in a good time.
If the economic pie is growing by 2 or 3% per year, which it has done for century, give and take wars and inflation and hyperinflation and technical changes and tax changes, but around about 2 or 3% the pie is growing. By the way, that comes from 2 places. It comes from population growth, and it comes from productivity growth.
Right.
So more people doing the same thing is about 1 or 2% in Australia, population growing, natural and immigration. And productivity growth is generally 1.5%, which means more people, not just more people doing things, but doing things smarter and producing more
efficiently. Yeah.
Now, that's a whole other debate about whether productivity growth is falling for whatever reason, but you can bank on productivity growth of around about 1%. Population growth around about 1 or 2%, that's your pie growing at 3%, 2 or 3%. That's where the pie comes from. So your normal cash rate in society is the economic growth pie growth rate, which is around 2 or 3%, population productivity, and plus also the expected inflation rate of 1 or 2 or 3%. Now, if our expected inflation is more, 2 or 3, 4%, it's going to require higher cash rates to rein that in. So it's a bit of a model that works in a circle, up and down through cycles. So that's the reason why I've always said in Australia, Canada, US, New Zealand, you're going to have rates of around about 4 or 5% cash rates, which it has been for decades when we return to normality, in order for inflation to be contained and the economy to keep rolling along without rolling recessions like we had, say, in the 70s. So if the cash rate endpoint is something in the order of 4 or 5%, we are now at 3-ish, bit under 3 in Australia, but rising. We've got another meeting in a few weeks, so that's probably another 0.5% rise. That'll take us up to 3 and a bit.
3.1. Yeah.
We're still not all the way there. So inflation is still running in Australia at sort of Australia's unusual, and we've had this. Australia's the only country in the world which has only quarterly inflation numbers. Pretty much all other countries have monthly numbers. Now, of course, you can do monthly numbers or weekly, or some people produce sort of daily numbers based on internet transactions and what they see on the web. So there's a bit of a lag between what the inflation number comes out. Now, the RBA, so the ABS last month introduced a monthly inflation series. So they can actually predict 80% of the components
Right.
Pretty much real time. So that they now produce a monthly inflation figure, which is running at 6 or 7, 7
Which
or
helps
8%.
manage expectations for when the quarterly number comes out.
Whereas you get countries like Europe, most countries in Europe produce inflation numbers like 2 days after. And in China, they produce inflation before it comes out. So they produce inflation
This
in
year,
advance.
inflation will be X.
The problem with all that is that you're backward looking. So we're trying to work out, the RBA is trying to say, well, not only are we back looking at inflation, but it takes a while. Now, we've had 6 rate hikes in Australia.
Fairly short period of time, so
Those
May
have
to
not,
September.
The 6 rate hikes translate instantly into 6 hikes in mortgage rates. But people aren't really paying those yet. They've got 1 or 2 letters in the mail, 3 letters in the mail. But so the RBA is saying, well, we've done 6 hikes, but that hasn't flowed through yet. It's probably going to flow through over the next sort of 6 or 8 months as to the impact of those 6 they've already done. So the danger is if they go too far, people will start to stop spending, which hasn't happened yet. Spending's very strong. Cash in bank accounts is still very strong. We're still sitting on oodles of cash, trillions of cash that we were paid out in the COVID handout periods. That's running out soon. So spending is strong still, and the cash holding we built up in the COVID years is yet to be run out. So you look at retail spending, restaurants are full. Restaurants, if you can get staff, they're all full. You can't get a restaurant booking in Sydney. It's crazy stuff.
So Australia, much like the US, we sort of came a bit late, Australia later, and then had to go hard to catch up, and we'll be at 3% realistically, or just over pretty soon.
Yep.
And then there's possibly the scope to slow down somewhat, but it's a bit of an unknown. You're right, because if you're a floating rate mortgage, it still takes 2 or 3 months for that to be felt, and there's a lot of fixed rate mortgages that will roll off in the next 6 to 12 months, let's say, coming off record lows of 2% mortgages and suddenly in for a bit of a reality check.
Yes, there was about $90 billion of RBA TFF, the term funding facility, which was 3-year loans for business, and some went to housing as well. 3-year lows at 0.1% from May and then November 2020. That 3 years runs off in a year's time. So a lot of loans are going to be priced at, say, 1-ish%. They're suddenly going to go to 6%. A lot of businesses are going to be hit by that. At the same time, as you say, a lot of the fixed rate loans written over the last 2 years on housing at 2-ish% for 3-4 years, they're going to be refinanced coming up now, for the next 12 months. They're going to be refinanced at 4, 5, 6, 7% if you want to go long term. So meanwhile, if they go from fixed to variable, which is normally you get a 2-year fixed rate loan, then convert to variable, you've got a 2-year fixed rate loan like my daughter at 2% for 2 years and some 3 years. That's going to be rolled off into a floating rate loan of probably 5 or 6%. Now, people who didn't put much equity in, meanwhile, house prices are falling. If you borrowed 90% on a 2% fixed rate loan, and a lot of people did, house prices have come down by 10-ish, 15% by the time next year hits. All of a sudden you've got negative equity. That's not a problem unless you have to sell.
Unless you lose your job.
If you lose your job, that's where the problem is. Currently unemployment in Australia is 3-ish%, the US 3-ish%, even in Europe it's still low. So in the last couple of months we've seen a bit of a change in the numbers. 2 things we're seeing emerge, early signs. One is unemployment starting to rise. Now, in the case of the US, it went down to 3.5 again, only because fewer people look for work.
Yeah.
So it was
less people in the workforce.
It was actually not strong jobs market in that sense. And the other side of the coin is we're seeing also some of the inflation roll off. Oil prices have now slumped back again. Now that hasn't got through to the pump yet, but that will in time. In Australia, you've got the excise coming off, which is another 20 cents, which is a bit of a rankle in the system. But around the world, you're seeing oil prices fall, and as oil prices fall, that'll feed through to lower prices, which will bring down the inflation rate. So that will happen over the next 6 months. Inflation will come down only for that reason that some of the big items are coming down. Meanwhile, spending is slowing. People are running out of money from COVID, so they're actually cooling it. Mortgage rates are going up, so they're slowing spending. So over the next 6 months, we're going to see slowing spending, which brings us to the next question, which is the big question: is will we have a recession?
Yeah.
The answer is hell yes.
Yeah, that's really, and you talk well in your recent monthly report around a technical recession versus let's talk about a real recession and
Yes.
what has a more meaningful impact on the economy, on profits, and on unemployment.
That's right. So somebody invented this definition, which has become tradition now, that 2 consecutive quarters of negative real GDP growth, which is not a bad starting point, but that's not the definition of recession. US economy has been in recession on that basis all year. They've had the first 2 quarters were negative, and Europe probably as well, Japan probably as well, UK most likely is already in recession. Now, the Fed, or the NBER, which is the body that calls US recessions, has said it's not a recession yet, because even though it's been negative for 2 quarters, we have not seen jobs suffer and slow down in activity and spending. So spending is very strong, jobs are very strong yet.
Which is probably a pretty pragmatic argument.
That's right. In the GFC in Australia, we had only 1 quarter. The September quarter, which is the Lehman quarter, 2008 was negative, and therefore we technically, because what Kevin Rudd did, he did the school spending, and then he delayed the pink bat spending to try and get out of being accused of having a recession, which he did. Doesn't matter. Share market still dropped 55%. Everything went collapse. Unemployment rose, business bankruptcies rose. So for all intents and purposes, it was a recession here as much as it was around the world. Even though technically Kevin Rudd can't be accused of causing a sort of a Keating-style recession, which is like 5 quarters of negative growth. So it's all semantics. Ultimately, you want share markets. We're share market investors. We are worried about profits and dividends. In the GFC, profits collapsed by about 50%. Share prices collapsed by 55%, which is worse than any other country, including US, which is the cause
in Australia.
In Australia. So the question is, will you have a recession? The answer is yes, no question, which is a massive rise in corporate bankruptcies and business.
So you're taking the soft landing straight off the agenda, I think, as we probably all are.
I don't think it occur, because I think the US is the key, because they drive global markets. And you look at the US, particularly after the Jackson Hole meeting at the end of August, you remember the Paul Volcker recession, double-dip recession in the early 80s to kill the 70s inflation in the US. He made a mistake. He raised rates when he was first put in August 1979. He raised rates during the Carter years before Reagan got in 79-80, caused a big recession in 80-81, and then he paused. He said, whoops, we can't do that. There's too much pain on the street. So he paused in 81, and that caused, then he said, well, we can't do that again. We've got to clamp down again. So he had a double-dip recession. The pause in the middle was a mistake. So if you look at the charts, there's this massive double-dip recession in the US, which is very deep. Unemployment was 10+%, and it took a decade to get down. What Jay Powell has clearly said to himself is this idea of going slow or easing. What he did in 2019 was a big mistake. He doesn't want to make the Volcker mistake in 81 and pause because of the lags in decisions and seeing what the result is. He's going to have to come down harder again in stage 2. He doesn't want that. He said, if we're going to have a recession, this is what he's thinking is, I think now. He said, look, we're not going to make that mistake that I made in 2019 and Volcker made in 1981. We're going to do it hard and do it fast and get it out of the way. So get the recovery as soon as possible rather than a big double dip or triple dip. So that's the bear case, which says we're going to have a slowdown which requires business failures, profits falling across the board, 30, 40, 50%, like in the GFC, like in the COVID sell-off, COVID recession. So that's the base case, which says now they're not going to ease up. He's going to keep raising rates until he can see that real activity slowing to bring down inflation. Now, so that's why I say that now Europe's got its own problems with energy prices and
different
wars.
kettle of fish.
UK's got
demographic challenges.
The problems of the US squared. It's much bigger, but a narrow economy. Australia will follow the US for a couple of reasons. So probably we'll have a big recession in the sense of a large increase in bankruptcies, unemployment, and corporate failures and layoffs. like we've seen in the GFC. Now, if that's the outlook, what does it mean for share markets?
Yeah.
So in my I've always been bullish on recessions. In my monthly report last month, I updated a study I did back in the GFC and in the COVID recession, which says that in almost all cases, economic recessions, are good for share markets. So I look back over the last 21 recessions going back 150 years in Australia. I actually detail them one by one. That's why the report this month was a bit longer. It's 22 pages, which is a bit longer than usual. I go through every single recession and share market cycle since 1885 and demonstrate that, with only one exception, which is the Great Depression in 1931, the share market posted positive returns during recessions, including the 90s recession, including the 75 recession, including the GFC, including every single recession.
So what's your starting point and ending point for your measurement period there?
Well, the word that scares investors is recession.
Yeah.
During the recession, share markets do well. Every single case, including COVID, including the GFC, including all the big ones, except the 1931. And the reason is this, and I draw a nice chart outlining the cycles. The first thing that happens is share markets fall.
Before the recession?
Well before the recession.
Yeah.
In some cases, years before.
Yeah.
Most times, many quarters before. Why are they falling? They're falling because the expectation of next year's profits is going to fall. So when in recessions, most of them, and I go through this literally over 21 recessions, company earnings on aggregate fall 30, 40, 50%. Like they did in COVID, like they did in the GFC, like they did in the early 90s, early 80s, all recessions. Company profit, now that's not a coincidence. Company profits is an outcome of people spending less and profits being lower, and then dividends are cut. So share markets fall first, and we're already down halfway through, 2/3 of the way down. US markets down, as at last night, down 25%.
Yeah.
A new low for this year.
2-year low. Yeah.
So it's still 12% above what it was pre-COVID.
Yeah.
The Australian market is only down 12% this year, but we're under our pre-COVID high because we didn't have this massive tech bubble and we didn't have the big tech sell-off. So US market's down 25%. So it's already down half or 2/3 or most of the way down. And no recession called yet because employment's still strong. The next thing that happens is rate rises, which are in every recession, most times either rate rises or some sort of monetary tightening before rate hikes. You know, in 1959 we had rate hikes in the RBA for the first time. Before that it was things like taxes and sales tax rises and tariff rises or currency mix changes. So there are various means to slow spending. Nowadays it's rate hikes. They occur and they slow spending. So the next thing that happens is recessions occur. The next thing that happens is profits fall.
Yep.
And the last thing that happens is dividends fall. And you've got these four curves, which are just like four waves, all lagged by about 6 months. So the first thing that happens is share prices fall in expectation of lower profits.
Yep.
That's already occurred. But spending is strong. Profits is the next thing. So profits, what happens with profits is over the last 12 months, aggregate profits in the US, Australia, globally, they were growing at about 10% per year last year. They've now flattened off. What will happen over the next year is profits will fall 20, 30%. Now, that's the reason why share prices have fallen 20, 30% this year, because profits will likely fall next year. About 6 months after, the last thing boards do is cut dividends. So even if they're bankrupt, almost bankrupt, they'll try and maintain the dividend to maintain the share price, which never works. So only the last resort is dividends are cut. So when share prices rebound and bottom, that is the very day where the blood is in the streets, the papers are full of bankruptcies, unemployment's high, but share and profits are still being... Every day in the paper you see some company go bankrupt and losses and liquidations. That's when share markets do well because they can see, right, next year will be good, it'll be rebound. So share markets always work about a year in advance of the profit picture and a year and a half in advance of the dividend picture. That pattern of four waves I've got on my report, which I've overlaid to every single recession over the last 150 years, and it works almost. The difference in timing sometimes, like the COVID was very quick, but the pattern was the same in terms of sequence. So are we going to have a recession? Probably yes. It'll be deep. There'll be bankruptcies. Unemployment will rise to maybe double digits. Second thing is, that's good, because I know that's the time when share markets will rebound. We're already down 25%. It's probably already half done or two-thirds done. The next thing will be, and when share markets rebound, it's always when blood in the streets and sentiment is worst. And rebounds, every single one, including COVID, especially COVID, they're always quicker and stronger and broader than anyone expects. By the time you look around and say, what shares do I buy? They're up 30%. Yeah. So in portfolios, we have remained neutral in our growth defensive mix.
Just before we go into that, let's just set the scene there, because we have really took the opportunity for some of the strength that you talked about in the markets through that July and August period, as we discussed on the podcast before the last one, how we position portfolios really to try and protect capital through this period, because we can never, unfortunately, have the crystal ball of knowing how far will exactly they go and when will they turn around. And as you point out, when they turn around quickly. So we've got to strike the balance in here. But how are we positioned currently to reduce or try and limit the sort of capital volatility for clients' portfolios?
So this year, we could see bad things occurring. This is before the war. The war, Adam, was the icing on the cake in a lot of respects, but it was going to be a poor year anyway for a whole lot of other reasons. And inflation was already running at 7% in the US, 5% here before the war. So don't blame the war. It's about monetary policy being loose and fiscal policy being loose. That created inflation. The war added to that. So we remain neutral on the growth defensive mix, but we did a couple of things. We added a lot of value. We've actually down a lot. September was a good month, as it turned out. We're actually we made two main decisions in the portfolios at the start of the year, or actually late last year. We took out entirely listed property.
Yep.
And listed property in Australia and globally has been the worst part of the asset of the share market. So the listed property market in Australia is down 28% and they're down 30% globally. Even the shares only down 12% in Australia. And we have none of those in portfolios. Now, the normal neutral portfolio, diversified portfolio off the shelf, has got about 8, 9, 10% listed property in it in Australia. That's been clobbered. We had none of those. The second decision we made late last year and this year is to get out of, we talked about the fixed rate bonds. 70% of our fixed rate bond allocation is actually not in fixed rate bonds. It's in floating rate, which is drifting up now as cash rates rise. So those
but has suffered from a bit of credit market volatility. So down in the vicinity of 2 to 3% rather than 12 to 14 as you described.
That's right. So those two positions we can change quite quickly. I don't think bonds will have a good run for many, many years. So I'm happy with that decision. Listed property, which we're out of and have been out of for a year, I think nearly 2 years, they won't rebound quickly because they will have some of the COVID overlay of offices not being what they were. People, you look around the office here, only half the people are in.
Moving to online.
Industrial property's done very well, the Amazon effect, but that's now overcrowded. It's very expensive. So the retailing is still doing it tough with people not returning to the shops and Amazoning of the retailing sphere. Commercial property, office buildings are not going to go back to what they've been full and overflowing and full of life they were 5-10 years ago. So I think listed property's got a long path to come back versus the GFC where they bounce back quickly. On the fixed rate bond versus floating rate note issue, I'm probably happy with having floating rates because as cash rates get to 4-5%, those will go from returns of 6-7-8%, some of those. So I'm happy to have those, and bonds, even though they might have the odd run. Now, bonds are quite useful.
I'll just pause for a second because that's a really important thing for the listeners. Many of our listeners will be people that generate income off this portfolio to support themselves. And the big positive out of all this is compared to where we were at the start of the year where they maybe returned 2% income on those types of assets. We're heading to a world where we'll pay 5 soon, potentially 6 and 7 and 8 as you talk about over the next year or two. So there's plenty of positives in the current situation for them.
That's right. For income investors, it's actually been good as rates rise. I mean, we've had TDs at 0 for a couple of 4 years. Now you can get 4% in a TD, 2 or 3, 4% on a TD for a couple of years, which we couldn't get for the last 5 years. So there are some positives. Bonds will do it tough. Share markets will rebound very quickly and very strongly.
So we reduced in the last quarter our exposure to international shares. And
yes, we
US
did.
Shares in particular.
So I think it was middle of August. We made a couple of shifts, main one being we added a couple of funds in and we took some allocation, about 4 or 5% from global shares to Aussie shares, and Aussie shares have done better. Global shares, which is primarily US shares, are 60% of that pie. They are still dominated, but most of the market's cheap. Resources are cheap, miners are cheap, industrials are cheap, very cheap. Consumer discretionary is quite cheap. Traditional retailing is cheap. The only expensive markets really are, and they are big in the US, which are technology, online, social media, the Facebooks and Metas and Googles and Amazons. They are still, and Apple's it's not overly expensive, but it's not cheap yet. So that whole sector, which is like a third of the US market, is still expensive. The Teslas of the world, great idea, but it's vastly expensive. So further to fall. All of those big tech name stocks, they're all down 30, 40, 50% this year. That's what dragged the global market down, the US market down. Australia has none of those, or very little of those, so we're only down 12% this year. But when it rebounds, which is only months away, it will rebound very quickly and very strongly and very broadly. And we're positioned quite well for that.
Excellent. So, and before we know it, the end of the quarter's rolled around again, and we've got our next asset allocation, so we can expect to hear more from you and from the Stanford Brown Investment Committee around how we position portfolios through to the end of the year.
Yep, looking forward to it.
Thank you very much. Most insightful as always.
Fantastic.
And apologies to our listeners from the UK. You, of course, always remain very important.
We remain a subservient colony of the King, whatever he is, or King. What's his name? Chuck.
King Charles.
I'm going to start a campaign called "Let's Chuck Chuck," but
we might have to edit that.
He's on the coin. He's on the coin. He's the boss.
Thank you, Ashley. Thank you, everyone.